Well, in the past few months, my friend Peter's business is going pretty well, and the records that he's keeping is helping him to keep a track of all his business activities, and due to that, he's also more confident, and it's also overall helping him to take decisions. Thus, it's helping his business to perform better. He has now learned that he must keep his business and personal expenses separate and must always assume his business to be long-term or continuous. He also understands that he can only record the things which can be valued in terms of money and record any transaction on the actual price paid or what is liable to be paid and not on the market price. This is the 5th month of Peter's grocery business, that is August, and he has a little trouble understanding when he should write or record his transaction in accounting books, because the other day Mr. Y came to his grocery shop and said, "I need these 4 items, but I will come and buy them later." That day Peter was confused if he should record that in his accounting books. So what do you think? Can he record those 4 items as sold? Well, they haven't been sold yet. There isn't any guarantee that the customer will come to buy those goods. So when a sale is uncertain, Peter cannot record or recognize this as a sale in his accounting books. Either payment should be made or both the parties must legally agree on the transaction for it to be considered as confirmed. Now, the next day, the same customer comes and confirms this purchase. He signs a note that he is liable to pay $200 in 1 week's time, and he asks for the goods to be delivered. Here the price he agrees to pay, that is $200, was fixed on the day he confirmed his purchase. In this case, can the transaction be recorded? Yes. Here both the parties have agreed, means there is certainty that goods will be delivered and that $200 will be paid in 1 week's time. So Peter can record this transaction even though the actual cash has not been received. So this concept where you recognize or record sale of goods and services when transaction is certain or complete is known as the revenue recognition concept in accounting, because it tells us when to recognize revenue. Okay, let's proceed further. Now, after a few days, Peter ordered some stationery items for $580 from an online website. He needed them for packaging of his grocery supplies. Here, the price is confirmed. He paid the order amount $580 through a debit card. The delivery of goods is promised to be made in less than 2 weeks' time. Now, in this case, stationery is an expense for Peter, but it is a revenue for the seller because he made money out of sales. So, will the seller recognize or record the sale of goods as revenue? Yes. Because once payment is made, definitely a transaction is certain. So he can recognize this $580 as a sale in his accounting books. And Peter will simply record this as an expense. Now, here in all these cases, we were talking about the revenue, which means receipt from goods and services. And when exactly is this revenue supposed to be recognized or recorded or realized in accounting books? All these words mean the same thing. So when can it be recognized? 1. When transaction is certain. 2. When either payment is received or is legally agreed upon, means it is recoverable. And 3. The goods may be delivered or agreed upon to be delivered. So these are the 3 things to keep in mind for the revenue recognition concept, also known as the realization concept. Now, Peter's doubts are cleared, and I hope it clarifies some of your doubts too. Moving on from this month there was a special visitor in Peter's grocery store. The auditor. Do you know who an auditor is? He is a qualified official and it is his duty to check on the accuracy of business records. He demanded that Peter showed all of his business records. But now, in order to verify the accuracy of Peter's records, he also needed some proper proof. Like, if we go and purchase an item from a store, we get a bill as a proof. The seller saves this copy of the bill to keep it as a proof of his sale. He uses all the proofs like receipts, invoices, payslips, bills, etc. to support his records. So these little written documents are called as vouchers in accounting. Peter too had saved all the vouchers and he had attached them to his records as proof. As sometimes, government agencies or auditors may come to keep a check on your records. So this is nothing but the concept of objective evidence, meaning we should have concrete or physical evidence or proof of all our records, and the records should be objective. That means it should be unbiased, non-influenced by personal judgments. It should not be mere imagination. So this was all in the month of August. Peter is doing well, and in our next session, we will come across some more interesting concepts or principles, and we'll continue to see what is new in Peter's grocery business. Till then, share in your comments below. If you like this video, please hit the like button, and if you haven't subscribed yet, you should. We're going to keep trying to make accounting simpler for you. Thank you.